AGNC looks to be undervalued and currently offers a 16% yield, but is it a buy now, and at what price should we be adding this to our portfolio? We're going to take a look at the historical performance of AGNC Investment. We're going to look at their income statement, their top line revenue, as well as their bottom line net income growth. We're going to look at their balance sheet, their total cash versus their total debt to get a quick health check of the company. And we want to look at other companies in the mortgage REIT industry to see how well or how poor they have performed over the last few years. And we will discuss their dividend safety. It does seem to be unsafe. Is there a potential dividend cut coming? And we'll look at some very important financial metrics you need to understand before investing in this mortgage REIT company. And we'll take a quick sneak at what the institutions are doing, whether they are buying or selling this company. And as always, we will run them through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given our investor margin of safety. Now, it is down 15% year to date. Investors who have been holding this company over the last 10 years would be down around 54%. Not very good, and we can see it has peaked at around $24 quite some time ago. So is this company looking to rebound? Can we see the share price double or even triple over the next few years and see that yield on cost go even higher to the 20s or even 30%? Now, jumping into their income statement, looking at their top line growth year on year. Now, typically for REITs, we do target around 5 to 10%. And what we can see for AGNC is their top line has gone from around 229 million in December 2018 to a loss of 1.1 billion. So not the greatest from what you want from any investment and the way it is run, but it is a mortgage REIT. They are volatile, there are ups and downs, and what you can see in the trailing 12 months for December 2023, it seems to be that we are expecting there to be a nice net income on the bottom line, which we will analyze. And as we can see on a more granular level for the top line, it has increased to 2019 before decreasing to a net loss and then rebounding and then falling again before what looks like to be a net income, or in fact a top line revenue of 400 million. Now, how does the bottom line net income compare? Well, 129 million reported in 2018, a loss of 1.2 billion. So again, we can see some inconsistencies. It has increased to 2019 before decreasing and then picking back up and then decreasing. And again, similar to the top line, we are expecting, as we can see here, a net income as well as we saw above a revenue which is positive. Now, in terms of the balance sheet, total cash versus total debt, 921 million of cash in 2018, 493 as per their latest quarterly accounts. So their cash has dropped to about half over the last 5 years. And how does that compare numerically and directionally to their total debt? Well, we do see it in fact go from 76 billion down to 52 billion, which is a significant jump. So we can see they have paid off a large chunk of their total debt. Now, the mortgage REIT industry is risky. How does it compare in terms of AGNC versus some well-known competitors in the industry? Well, year to date, AGNC with those dividends reinvested are down around 2.4%. In fact, towards the middle of their peers, with only, as we see here, RITM making a positive return this year. Now, when we extend that to the last 5 years, AGNC is still down around 10%, but it is the second best performing in the industry. And what we can see, effectively every single competitor has given a negative return. So something just to bear in mind, but also something that is key is that past performance is never essentially an indicator for future performance. Now, a quick look at the institutions, 39% institutional ownership, around 461 million worth of shares bought by the institutions over the last 12 months, with slightly less than double that bought in the same time period. So we see institutions are liking this company. They are buying more than they are selling. With the large 4 quarters, we can see more buying, depicted by the green, than selling, which is depicted by the red. But as always, we don't copy what the institutions do, and we always do our own due diligence. Now, before jumping into the dividend safety, let's take a quick look at their latest earnings report. And we can see they did beat, in fact, on the top line by 2 cents. However, they did come in significantly under on the top line with a miss, a significant miss. Going back to Q2, we also see a very similar story, beating on the earnings per share, a miss on the top line revenue. And if we go to Q1, again, a very similar story. So they have missed all Q1 to Q3 top line, but they have beaten on the earnings per share. Now, when we compare the revenue from Q3 23 to Q3 22, we do in fact see they did beat their top line from last year. They did beat their bottom line as well as the earnings per share, net profit margin, and operating income. So there are some real positives to take from AGNC when comparing to last year, as well as when looking to their central quarterly reports. But again, always good to look at the positives as well as the negatives to get a clear conclusion. Now, dividend safety score 23, unsafe, probably the lowest score we've ever analysed on the channel. Market cap 6 billion, so it is effectively a mid-cap company. Now, recession, they did increase the dividend during the last recession, and surprisingly, they had 62% recession sales, which was above the average growth of companies in the S&P 500 during 07-09, which was in fact negative to a large degree. Now, dividend growth, unfortunately, haven't had any increases since 2020, and they did have a dividend cut, so we do see negative 8% on average over the last 5 years, negative 12% over the last 10 years, bearing in mind this dividend is significantly high at 16%. Now, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average, so we have our first sign of undervaluation. Bear in mind though, we're not looking at any of these models in isolation and drawing our conclusions towards the end of the episode. Another sign of undervaluation, forward PE of 4 versus a 5-year average of 6.3, and we can see the sector PE significantly higher at 10.7 versus AGNC's 4. Now, what is very important in terms of the dividend safety is to take a look at the earnings payout. Now, typically we look at the free cash flow, but essentially for REITs it is more volatile, so we do focus on earnings. Below 95% for mortgage REITs is our target, and over the last 10 years it has consistently been either around that point or slightly lower. In fact, we see 2020 and 21 in the mid-40s, although 23 is expected to come up slightly higher to around 50 to 60%. Now, earnings per share, it has decreased from 2013. We see $3.86 in 2013, $3.11 in 2022. So it has come down, but we do see that big drop from 2013 to 14. And other than that, it has remained fairly stable, but you do see some increases followed by decreases. Now, when we take a look at the shares outstanding, now it is typical for REITs and mortgage REITs in particular to issue shares to effectively dilute your position as a shareholder. Now, the reason why this is because mortgage REITs generally have to borrow money and issue shares to grow their business. So what we can see is they have issued shares from 2013, 379 to 537 over the last 10 years. Some REITs do this at a faster rate than others, but regardless, just bear in mind that your position as a shareholder over time does get diluted. Now, when we take a look at the ROIC, it is one that we typically look at on the channel. It is important, but for REITs, again, it isn't one that we can use. It's not meaningful given, as we see here, their complicated sources of funding, and the same is something that is said about the operating margin as well as that net debt to EBITDA for mortgage REITs. So slightly fewer metrics that we can analyze for AGNC. But that is essentially the analysis, and now we can jump straight into the valuation model. As always, if you enjoy the content, value is being provided, do smash that like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And if you want to grab a copy of the valuation model, then do click on that pinned comment below where you can get to the intrinsic value and acceptable buy price of companies in your own portfolio. Now, jumping onto the first model, now typically Graham's valuation would be the first out of the 4 models, but for REITs it isn't one we use. But if you're interested to see what we do, we put the stock ticker, the earnings per share, growth rate per analyst estimate, and the current yield on AAA corporate bonds to get us an intrinsic value. So the second model, or in fact the actual first model we're using today, is the multiples valuation model. Companies in a similar sector and size, the mortgage REITs industry that we analysed over the last 5 years, we see their stock price, earnings per share, P multiple, average P multiplied by the earnings per share of AGNC to get a stock price of $12. Now, when we take a look at the current trading price, that is pretty much there at that 52-week high, showing signs of around 50% upside and undervaluation in the current market. We then move on to the second model, the dividend discount model with our yearly dividends. Now we see they have had some dividend cuts and some years of flat growth, effectively 0% increase. Forward looking, I've gone for the same 0%. Now, for those that do argue it should be higher, you can grab a copy of the model, play around with the numbers based on your own investment thesis. This gives a DDM price of $17. Now, when we take a look at the current trading price, that is around double the current price, so 100% upside and showing signs of some severe valuation in the market for AGNC. Now, typically the discounted cash flow would be the fourth model that we would use. However, due to it being a mortgage REIT, it is very volatile. As we can see, the growth rate negative nearly every year. This isn't one that would be relevant. However, what we typically do, we'd have the free cash flow, we'd have the average growth rate with the growth rate per analyst estimates and the discount rate to get the sum of the future cash flows, add to the cash, subtract total debt, get to the equity value, and then divide by the shares outstanding. So the intrinsic value for AGNC in today's episode is purely the average of the two models, the essential multiple valuation model and the dividend discount model, and that comes to $14.51. Now, as always, if you do enjoy the content, value is being provided, do hit that like button. In fact, smash the like button. It really helps the channel grow, pushes the video out to other viewers who would like to see the content. And if you want to subscribe, hit that bell button so these videos drop to your doorstep as they drop on a regular basis. Now, margin of safety, what we typically use would be 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. Now, I know a lot of people with mortgage REITs, it is a lot riskier than the typical REIT, whether it's Realty Income or Vici Properties and so on. So you would be looking at a much larger margin of safety. Now, effectively, for AGNC, you would be locking in a 35% margin if you were to acquire this up to $9.43. If you were looking at 40%, you would be waiting for around $8.70. So you are getting between a 35 to 40% margin of safety. Now, Wall Street, what do they believe? Well, they see very minimal upside to the current trading price over the next 12 months. In fact, around 10 cents. But as always, do let me know your thoughts in the comments below. Personally, mortgage REITs isn't one that I will be looking to add to my portfolio. The yield does look extremely high at over 16%, and it doesn't look like this will be sustainable over the next year or two. So for me, this isn't one I will be adding. But there are a lot of people that I know that will add this to their portfolio, or in fact have this in their portfolio. So let me know your comments below why you believe that AGNC is one to have in the portfolio. Or if not, let me know why you believe this is a definite do not hold in the portfolio. As always, if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, click on the pinned comment below. And if you do enjoy the video, enjoy the content, want more of the same, smash the like button, hit the subscribe and bell so these videos do drop every single day. As always, have a great day, catch you on the next episode and take care.